Good morning. Welcome to Flaya's Real Estate Direct Lending and Private Debt Forum Part 10. This is the 10th in a series. We would like to thank our sponsors, Nationwide, Preqin, Boomerang Capital, S&P Global Market Intelligence, Safe Harbor Equity, Harvest Volatility Management, Millennium Trust, Apex One Investment Partners, Intrust Global Off the Chain Capital, Sunshine Properties Trust, and Sheridan Asset Management for making this event possible. We'd also like to thank all of our Flyer board members and Flyer members for their support during these challenging times. For those of you who are not familiar with Flyer, Flyer is a 501c6 nonprofit organization started in 2007 with the goal to become the world's leading marketplace for alternative investments and alternative investment education. Since then, Flyer has helped thousands of firms in a capital raising process, aided in the allocation of billions to alternative investments, and leveraged technology to accelerate the due diligence process. Today, Flya has over 8,000 members on the platform with over 5 trillion in discretionary AUM. We would like to inform you of some of the events we have in February. On February 4th, we have Artificial Intelligence, Blockchain, and Cryptocurrency. We call that ABC Forum. That's February 4th. On February 16th, we have Real Estate Direct Lending and Private Debt Forum, Part 11. Other exciting events we're planning for this year include an ETF Day, Life Sciences Day, ESG, and the Fourth Industrial Revolution. So please mark your calendar, and we hope you can join us for those upcoming events. Our first presenter today is Cameron Joyce, Vice President of Research Insights at Preqin. Cameron?
Thank you, Rainford, for the introduction, and good morning, everybody. Thank you for joining the presentation today. So I'm a member of the recently established Research Insights team at Preqin in London, and today I'm going to be providing a brief overview of the developments that we've seen in the broader capital markets and broader private capital markets in particular, with a focus, of course, on private debt and real estate. So before I go into the overview, I'm just going to provide a brief introduction to Preqin for those of you who are less familiar. We are essentially a data research and insights provider for the alternatives assets industry. We have over 300 investment professionals working across the globe, across the several offices that you can see there on the map, and they're collecting, collating, and organizing data across a range of asset classes, including real estate and private debt, but also private equity, hedge funds as well. So without further ado, I'll move forward onto our overview of the markets. So firstly, I'm not going to go into too much detail about what's happened in the last 12 months. I think everyone's quite familiar with the events as they've been unfolding. But what I will say is that compared to several months ago, some of the most recent data points that we're seeing are actually quite positive in relation to what we were expecting. So actually, it's quite an upbeat outlook going forward. And obviously, it's been a challenging year, but we've actually seen the AUM up until June last year actually increased despite what was happening in Q1. And obviously, that's clearly a function of central bank responses and fiscal stimulus as well. So it's up for the debate about how healthy that is. But let's have a look then where we stand. So as of June last year, it's surprising in many ways that for private capital as a whole, AUM was actually up compared to the end of 2019. So you can see here the breakdown. Obviously, private equity is a large part of the mix, but private debt and real estate obviously making up a significant chunk as well. Now, the longer term picture, of course, looks very positive, very strong growth from before the global financial crisis up until today. And the current situation of low long-term government bond yields and a benign inflationary environment is obviously quite positive for this asset classes as the market continues to rotate into it. I think broadly speaking, amongst institutional investors, there's an acceptance now that 60-40 traditional portfolios just don't work. And that's why we've seen the ongoing rotation from public equity into private equity, and also a number of the other alternative asset classes to replace traditional fixed income particularly in Europe, of course, but also increasingly in the US. Now, the strength of the rebound that we've seen so far has led many to question whether 2020 will actually prove to be a good vintage for many private equity portfolios. I mean, obviously the sell-off in risk assets was relatively brief, and the recovery was so sharp that it may not be the case. So we'll just have to see as we go forward. So dry powder, just to put it into context, so almost 2.5 trillion of dry powder across private capital. This again is an increase on the end of 2019, and the total amount is more than double what we had in the aftermath of the global financial crisis. Now, just have a closer look at private debt. You can see there that we're approaching 900 billion in AUM as of June last year, which again is an increase on 2019. So a pretty sharp recovery from the sell-off we saw in Q1. And no doubt central to this recovery was the Fed's willingness to intervene in the corporate bond market. I think we're all very familiar of the risk that we're building up there, with a lot of corporates buying back stock by leveraging up to buy back that stock. And that meant that there was a lot of BBB debt out there. And obviously when the pandemic hit, there was a lot of concern that a lot of that BBB was going to slip down into junk and cause some material market dislocations. But the Fed's intervention prevented that. And of course, now we see a situation where corporate bond yields have just created, I think BBB spreads now are something in the region of 125 basis points. So the fact that that market has averted serious problems means that private debt can obviously continue without any contagion from that. So in spite of everything this year, private debt AUM from the end of 2019, it was actually up 45 billion, which is a relatively modest increase of 5.3%, but not bad considering. So real estate, obviously this is now, looking at the longer term picture, this is now a large asset class that has achieved critical mass. We're looking at over 1 trillion in assets, 1.1 trillion in total in global real estate AUM. Resilient fundraising this year, 118 billion raised, and returns are pretty solid. I mean, if you look at median annualized returns over the last 3 years, we're looking at 5.7%. And in terms of the responses that we're getting from institutional investors, we're seeing continued interest in the asset class. Obviously, there's some pretty severe challenges that the sector is facing, but the appetite remains strong, at least in the long term, with 90% of respondents that we've spoken to they're expecting to either maintain or increase our allocation to real estate going forward. Now, to move on to fundraising, this is something that, again, a few months ago, we were expecting a much steeper drop-off in fundraising in 2020. And indeed, there has been a drop-off, as you would expect, but it's very much a continuation of the slowdown that we've seen in fundraising from a peak in 2017. It's interesting to note as well, I mean, if you look at the numbers in 2018, 2019, you can see a pattern of capital consolidation or concentration in those years where you've seen a lower number of funds closed, but actually an increasing amount of capital raised. So in other words, a small amount of larger funds being raised, and they're typically the large managers that are taking up that fundraising. So that's created a particularly challenging environment for first-time managers. Obviously, 2020 is a bit of a different story, a slightly steeper sell-off, but again, not as bad as we were expecting. So to look at private debt, just to put it in context in terms of geographies around the world, I mean, obviously North America remains a very dominant part of the mix, but the role of Europe is increasing. We've also seen some strong growth in Asia from a very low base, but Asia is still making up quite a small portion of the total. So for 2020, as I said, $118 billion raised across 200 funds. Real estate, obviously some more specific issues with the sector compared to other alternative asset classes. I mean, we've obviously got some permanent shifts in behavior which we're all familiar with. So the fundraising picture has been hit, but perhaps not as severe as we were expecting again a few months back. So this is a sector that we're more conservative on, perhaps, when it comes to our future forecasts. We're expecting the sector to reach 1.24 trillion in assets by 2025, which is a relatively modest 3.5% CAGR in AUM over that time frame. Now, the amount of investors in the real estate segment that we're tracking has increased quite dramatically. Active investors up 80% in 5 years, up to 8,700 in 2020. So this is clearly an asset class that's gaining traction, and the amount of institutional interest has been steadily increasing. Now, if you look at where the interest is coming from, large pension funds account for around a third of that figure. But we're also seeing, interestingly, quite a lot of interest coming from smaller players. So entities with less than 500 million AUM make up 37% of the mix of interested investors in this sector. Now, of course, fundraising has been challenging. So that means that the amount of funds still in the market has increased, and we've actually seen a record number as of the end of last year. So 547 private debt funds in the market, targeting just shy of $300 billion, which is a 51% increase on last year. And obviously challenging conditions, but not too bad. Real estate, similar figure, again, very strong numbers in terms of the amount of funds on the road, a record, in fact, and they're targeting a slightly larger increase in what they're trying to achieve. Now, again, as we saw with fundraising in AUM, there has been a gradual slowdown that's been taking place. I mean, there's some late market dynamics coming into private capital as a whole, but we can see that if you look at private capital deals as a whole here, the activity appears to have peaked back in 2018, and that's a trend that may well continue, and COVID only seems to have exacerbated an existing trend. So private debt deals, a sharp decline there, just to have a brief overview, but it's interesting if you look at the amount of deal value, it's held up comparatively well. So there is a smaller amount of larger deals being completed, which is a trend that we're seeing across other private capital asset classes as well. Real estate deals, a sharper drop off and less of a trend of capital consolidation there. Now, in terms of the geographical breakdown, we can see that obviously, as we saw before, North America remains pretty dominant in the private debt markets, making up the majority of the deal value that's taking place. But again, we're seeing more participation from Europe. The European share has increased, but remains relatively small. APAC, the private debt markets are still relatively nascent, and we're not tracking as many deals there compared to the maturer markets of the US and Europe. Now, here's a good breakdown of where that deal value has come from in terms of sectors. You can see that financial services and insurance have held up comparatively well there, and also a slight increase in consumer discretionary actually this year, despite the challenges that those sectors have been facing. Real estate, again, a much sharper drop-off across the board, really. But that's showing you there the breakdown of real estate deals by sector. Now, one of the areas that we've been fielding a lot of questions from our clients has been the impact of first-time fundraising. This, as I said, I mean, it's obviously been a difficult environment over the last few years already. But many of us were expecting and hearing anecdotally that it was becoming an extremely difficult scenario in 2020, given the fact that we've had to conduct due diligence remotely and get used to that. And the trend anecdotally seems to have been that allocators are more comfortable allocating funds to existing relationships, which means that first-time managers have had a particularly tough time. Now, the data that we've seen more recently has shown that actually it's not as bad as we thought. If you look at private equity, the portion of total capital that's been raised by private equity from first-time managers is actually around the same level as it was last year. So there hasn't been a marked deterioration, but that level, of course, is still low in comparison to the last several years. So we'll have a look now at what it looks like in the private debt market. So 10% of total capital raised in 2020 was from first-time managers, which is actually quite a good result, and that's higher than it was in 2017. So a bit of a mixed bag. I mean, we've seen different trends in private equity compared to private debt. But in terms of the number of funds closed, they account for 20%, which is slightly lower than it was last year, but not that low in relation to years earlier than that. Now, if you just look at the numbers here, there's quite an interesting split. You can see that proportionally, the number of funds in North America, first-time debt funds have been lower in relation to other regions. Now, another chart that we like to look at, and we get a lot of questions about, is how to monitor the capital concentration. Now, this is quite a surprising picture, really. I mean, we have seen an increasing capital concentration when it comes to private debt in 2020, with, if you look there, 39% of the total capital being raised from the top 10 funds, which is an increase on last year, but it's not out of sync with what we've seen in prior years. So there hasn't been a major shift due to COVID, which a lot of people are finding surprising, but obviously quite a good situation for first-time managers. Similarly, with real estate funds, 5% of total capital raised in 2020 was from first-time funds, which is the lowest it has been. So it is a bit more severe, but not considerably so. 17% of the total funds closed in a year were first-time funds. And again, just to have a look at private debt in terms of the funds closed by geographical focus there. So that's it for first-time funds. Another thing I'm going to go into now is I'm going to look at our projections that I mentioned before for AUM across private capital. We put these together in October, so going forward, we're going to keep revising these numbers. But we have a breakdown of AUM for alternatives as a whole, but we also have a breakdown for each asset class in each geography, which I'll go into now. So the headline number is 17.2 trillion. So that's private market AUM. So that's including hedge funds. And already you can see there that the 2020 figure has changed somewhat. That was our original estimate when we put this report out, but the likelihood is that when we get the final AUM data for 2020, it will already be higher than that. So whether that means that our 2025 figure increases as well, we'll have to see. But it may be that just because AUM has done so well in 2020 because of stimulus, it may be that a lot of that growth that we were expecting is simply just being front-loaded in 2020 and 2021. So the growth rate overall, if you look at the historical CAGR of 10.2%, the growth rate going forward that we expect for the market as a whole is relatively speaking in line with that. But as we'll see now, I mean, if we look at the makeup of that growth, there are some quite stark differences when it comes to geographies and asset classes within that. So what I'll do now is I'll show you a brief snapshot of where we expect that growth to come from in terms of the geographies. North America, of course, will remain the dominant market in private capital and hedge funds as well. But of course, we're seeing or we're expecting extremely strong growth in Asia. And I think this is, it's clear to see why. I mean, obviously, China has a large role to play in this. Now, clearly, there's a huge amount of domestic savings in China, and because the banking sector hasn't done a particularly good job of absorbing those savings, there has been strong growth in the shadow financial system, which we've heard a lot about in the last several years, but as we know now, Beijing is trying to formalize a lot of those savings and put them into more traditional asset classes, including public equities and bonds. But we expect continued flows into alternative assets as well. More recently, it's been a challenging environment because there has been some regulatory changes in China, which has meant that pension funds have been less able to allocate. But going forward, we think those restrictions will start to ease, which will allow this growth to come through. So overall, North America and Europe, comparatively speaking, the maturing market. So we're expecting good solid growth, but not as strong as it has been in the past. So 30% over the period from 2020 to 2025. But Asia is really the standout player, with growth more than doubling there. Now, just to have a look at the breakdown by region, as I said, relatively modest by historical standards for North America and Europe, CAGR. This, remember, is for alternative assets as a whole. We'll look at the breakdown of these in more detail later. So APAC, that's the standout, so 25% CAGR, and we expect alts to reach just shy of 5 trillion in 2025. Latin America has been a slightly different story because, of course, that market's been more heavily impacted by the impact of the pandemic, and as risk assets, they've sold off a bit steeper than other markets, so the base is lower, which means that the growth going forward is slightly stronger, of 11.1%, but nevertheless pretty good growth coming from that market as well. So by far the strongest growth of any alternative asset class that we expect is private equity, 15.6% there. And that's actually an acceleration compared to what we've seen in the past. And we think that what's key to that is the assumption that government bond yields will stay low, and that critically the long-term inflationary expectations remain anchored to low levels. And I think clearly there's some risks at the moment. I mean, I think a lot of people are expecting some transitory CPI pressure, but at least on our team, we expect that to be predominantly transitory in nature, and more to do with the fact that we're coming out of COVID. There's a lot of there's low inventory levels, there's pent-up demand, and there's disrupted supply chains. So that may cause some inflation in the short term. And of course, the Fed has indicated that they're prepared to pass this through by adopting average inflation targeting, which means any short-term inflation that gives them the ability to pass that through without raising rates. But critically, we don't think that's going to translate into longer-term inflation expectations, which means that long-term government bond yields can remain low. And of course, that underpins the growth story across much of the private capital space as well. Right, so more interestingly for you guys then, so private debt is the second strongest category that we're expecting growth for, so 11.4%, and we're expecting, as I said before, about 1.5 trillion by 2025. Real estate, we've been relatively more conservative on, 3.4% CAGR, and given the expected returns of the real estate segment, I mean, historically, according to our data, it's been producing about 5.7% of IRR returns in the last 3 years. That means that actually we're implying some net outflows from the asset class. And I think, actually, I mean, a lot of our client feedback has suggested that possibly we're being quite conservative here. But obviously, this is a segment where there's a lot of dislocations right now. As we said, some pretty serious structural issues going on with permanent shifts in behavior, which we all know about. Infrastructure by comparison, again, because we have this situation where the 60-40 split traditional portfolio just doesn't seem to work. There's increasing appetite for infrastructure and from investors looking at alternatives to fixed income. So that's where we expect continued demand and continued interest from investors. But by comparison, relatively more muted growth. Natural resources, of course, have had a tougher time in 2020. given the volatility in the market. So again, a lower base, which partially explains why the growth expectations here are slightly stronger. And hedge funds, finally, I mean, we do track this as well. Now, hedge funds is a space where we've just seen a lot of pressure from alternative options in terms of, we've got smart beta products, we've got ETFs, and an ability for investors to track or replicate what hedge funds are doing. So we expect reasonable performance from the hedge fund sector, but we're also expecting net outflows from this category, which means that the CAGR of AUM for the sector is relatively modest at 3.6%. Now, if we ask our investors, which we do on a regular basis, our investor LP clients, it's good to see actually that their responses are pretty much in line with what we're expecting for growth in terms of various geographies. North America, of course, will remain a very important part of the mix, but perhaps going forward, it's not going to be as focused on. I think a lot of attention is clearly shifting to emerging markets in Asia. Now, of course, one thing is to have interest, but one thing we're looking at very carefully is really the capacity of these markets to absorb that interest, which is obviously a function of deal flow. And there's obviously a lot of nuances across Asia. It's a much more nascent market, but we expect the outlook, the growth from a relatively low base to be quite strong going forward. Now, we also ask investors and fund managers what they thought that the key risks and opportunities were going forward. And you can see here quite an interesting split, really. The key things that managers are concerned about across private capital tend to be domestic politics, geopolitics, barriers to trade. But the areas where managers are perhaps more optimistic on are interest rates, asset valuations, and the exit environment, which particularly in the US in venture capital has been very, very strong on the back of the stimulus we saw more recently. So I think, as I mentioned before, I mean, the thing that we probably have our eye on is long-term inflation expectations. Not because we think that's a likely scenario that they're going to increase materially, but we think if that were to occur, that would obviously be would have a significant impact on the performance of the sector of many of these asset classes within alternatives, that is. Now, at the moment, we're putting together our annual global asset class reports. We're currently in the process of doing that. We're going to have reports coming out for each asset class early next month. So as part of that process, we've been thinking about what some of the key themes are that are developing, not just in immediate terms because of COVID, but also in the longer term. And one of the things we're noticing, particularly with the larger GPs in the US, is that we're seeing an increased shift towards permanent capital. Now, of course, the use of open-ended funds is challenging because that obviously introduces a lot of liquidity risk for GPs. But the thing that we're seeing is that there's been an increasing amount of strategic acquisitions of insurance companies, which makes a lot of sense because, of course, interest rates are where they are. We've got 18 trillion across the world of negatively yielding debt. So the insurance companies are having a very tough time and trading at quite low valuations, which means that GPs can come along, acquire one of them and have a captive source of permanent capital. So this is a trend that's obviously been happening. There's been a few high profile cases of this happening. And going forward, we think there's probably going to be more of this happening in a similar vein. So KKR is one example with Global Atlantic Financial Group acquiring in a $4.4 billion deal, 71 billion of insurance assets at book value, which is pretty good. Apollo, of course, has had a long-term relationship as well with an insurer, and Carlyle has made an acquisition. So this is something that's been happening. We expect it to continue to happen as well. Now, another thing that we've been monitoring, again, it's more of a long-term trend, not something that's just happened in 2020, but I think this is really just a natural evolution of the industry. I mean, obviously, when LPs are relatively inexperienced in the asset classes within alternatives, they tend to buy fund of funds and then perhaps select particular buyout funds. But we're seeing now an increased appetite for co-investments, which is essentially the next stage before direct investments. Now, just to show you a breakdown here in terms of, this is in private equity now, but we saw a very clear trend in our investor responses from where the appetite was coming from. And it was interesting to see that if you look at the LPs that have between 1 and 10 billion, they are either co-investing or interested in co-investing. The majority of them are. So that's quite interesting and revealing. And I think that's probably just represents that's perhaps the sweet spot where anybody who's lower than that might find co-investing a bit challenging, because perhaps they don't have the capital to participate in those deals. They don't want those co-investments to be too large in their portfolios, but also the larger players perhaps they might not find it as rewarding, because it's a lot of work for positions that are relatively small in relation to their overall portfolios. So that's something that we've been seeing. Now, for private debt, this gives you an indication of where the appetite is coming from for co-investments. So you can see there that the co-investors, sovereign wealth funds are playing a large part already, as are fund of fund managers, family offices. But overall, we expect that that portion of people who are actively co-investing and interested in co-investing to increase going forward. So that's obviously an opportunity for GPs, but it's also a bit of a threat. I mean, it does have the potential to erode the management fees that they can earn. So moving forward then, so just looking at from the point of view of real estate sector as well. So the types of institutions that are co-investing already, again, fund of funds, sovereign wealth funds, are two of the leaders in that respect. Now, another key trend that we've been seeing is the rise of ESG. Initially, it was to do with LPs requesting, complying and requesting ESG compliant products, but also the adoption now amongst GPs is accelerating. So an interesting trend here. This chart is not as up to date as the other ones, but you can see now that ESG committed funds are playing an increasingly important role in terms of the overall fundraising going forward. Now, obviously, there's always been quite a big debate among investors about whether ESG can actually help or hinder returns. I mean, there's an argument to be made that, well, actually, if you're going to limit your opportunity set and you're going to compete for compliant assets, then there's a chance that you're actually going to impede your ability to perform compared to managers that aren't compliant with ESG. But there's also an argument to be made that, well, historically, ESG has actually led to outperformance. And we've seen that particularly in the public equity space, where there's empirical evidence that ESG funds tend to outperform. Now, our views are that looking at the comparatively limited data set that we have so far on ESG, that there's no evidence that ESG funds underperform. So that's a good thing, because that means that investors can essentially do good without compromising on returns, which is a great result for everybody. Now, obviously, we have to note that ESG is a relatively new concept. So as I said, we don't have that much historical data. And also, when we draw comparisons with public markets, we're also a little bit skeptical about that analysis, because obviously the tech sector has done particularly well, which is ESG compliant, but typically ESG compliant, and the energy space has done particularly badly. But I'm not sure that many people would attribute the performance of the FANG stocks to their green credentials, which makes us a bit more skeptical about whether that outperformance is a function of ESG policies per se. So there's plenty of, we have actually launched an ESG product more recently, where you can track how LPs and GPs are doing in terms of their ESG activity. So that's definitely worth having a look at. Right then, so I'll just run through a brief summary of what I've been through. So obviously, big surprise, really. Well, it's a surprise in a way compared to what we were looking at in March last year, that AUM has increased quite markedly. And we're only talking up until June last year. So the fiscal and monetary responses that we've seen have obviously gone a large way to helping that. So private capital AUM already above 7 trillion, but we expect that to continue. So yeah, slowdown in fundraising as we've seen. Future AUM growth, we think private equity is the strongest growing asset class going forward, but private debt is not far behind, with over 11% CAGR in AUM. But one of the key themes that we're expecting as well is that APAC will have the strongest growth from a low base and become an increasingly important part of the mix. ESG, of course, is now mainstream. It's clearly no longer something that's on the fringe. The adoption among LPs and GPs is very clear to see, and we expect that to continue going forward. Our view is that it doesn't hurt returns, which is good. And yeah, that's it from me. So just to leave things on a final note, I mean, as I said before, I think the central risk factor that our team is looking at is longer term inflation expectations. And that's not because we think this is going to be a problem necessarily, but we think if it were to become a problem, it would obviously have a material impact across private capital. Now, the accelerated growth we've seen in PE is very much conditional on long-term government bond yields remaining where they are. Obviously, we have the US government 10-year at about 1.1% right now, which is pretty low. And for the private debt space, I mean, just as a comparable, I mean, triple B spreads at 0.25% at the moment, so that's not that's pretty good. But of course, that comes off the back of some unprecedented moves we've had from the Federal Reserve, and how healthy that will be or how sustainable that will be, we'll have to see. Okay, so that's it from me. I think if you do have any questions, we can certainly send these slides through. But if you have any particular questions on anything that's come up today, I mean, please do ask us. I'm seeing a few coming through already. If there are any specific questions on private debt and real estate, we can certainly forward those to the teams, to our teams, and we'll get back to you separately as well. But otherwise, I would just say, please keep a lookout for our global asset class reports, which are coming out very shortly. There'll be a very good one on private debt, good one on real estate as well. And that will be out on I believe the 5th of February. So that's it from me for now. Wonder if anyone would like to jump in with any questions.
So we have some questions. Do you mind if I read them to you?
Sure, yeah.
All right. So this is from Jeremy Goff. There's been a lot of talk about institutions not allocating to new managers, but rather sticking with who they already know. Could you speak to this and if it is changing?
Yeah, I mean, great question. Anecdotally, that's certainly what we heard earlier last year. I think it's clear to see from the data there that was an existing problem going into the COVID pandemic already. I think it's perhaps it's just a function of the industry maturing. Perhaps there's more visibility now on the track records of managers, and allocators are just more comfortable allocating to them. You could also just be more cynical and say that perhaps allocators are, they don't like the career risk. They'd rather allocate to a large brand name so that they don't have the career risk that's associated with that. But that's obviously an ongoing trend. And going into COVID, we expected that trend to continue and accelerate, in fact. But as we have seen, it just hasn't happened. The concentration fundraising just hasn't accelerated. So that's actually quite a good situation, we think, for first-time managers. It's obviously still a challenging environment, but it hasn't been as challenging as we thought it would be. So just as a reminder, I mean, I can probably bring up, that's not the right one. But yeah, I think in private equity, for instance, I mean, first-time managers raising 6% of total capital, which is a record low. But the long-term average is in the region of 13%. So going forward, we think that's probably going to increase, especially as we come out of COVID and social distancing and lockdown measures. But apart from that, yeah, it probably the outlook going forward is probably going to improve on margin.
That's great. Okay. So there's some people asking about the presentation and if they can get the actual presentation. Then a gentleman's asking, what is the basis behind the expected increases in AUM? What returns does Preqin expect for private equity, private debt, and real estate going forward? And that's from Tristan.
So the model that we ran has been run with our data science team. They've taken a range of factors, historical factors that they've plugged in, and they've come up with a model. We don't explicitly have return expectations at the moment. I mean, that's something that going forward we're going to continue to model. I think at the moment on the first iteration we have, broadly speaking, the asset class breakdown, but going forward we'll probably get more granular in terms of geographies and asset classes within alternatives, and then we'll also probably break down the split between returns and inflows. So that's something to watch out for. We're a relatively new team. We got put together mid last year, so that's something that we're looking forward to working on, and our forecast will get better as we go forward.
So Cameron, we got 30 requests for your presentation.
Okay, good.
That's a record. I think that's actually so does Preqin, do you guys believe that that it's most of the money is going to go towards larger managers, and that trend is going to continue? And I know you touched on it in the slide. This came up in the chat box.
Yeah, I mean,
it always seems that way. I mean, in general, right?
Yeah, I mean, I think it's inevitable. I mean, if you look at the breakdown of AUM private capital, I think in absolute terms that the concentration of capital will increase. I mean, obviously that's not just a function of flows, but it's a function perhaps of performance as well. I mean, there is some evidence that larger managers, top tier managers, do have some return persistence as well, so that will help. But as I said, I mean, we thought, our answer to that question would have been a bit more definitive a few months ago, because we thought absolutely it's just there's no way that first-time managers can compete in this environment. But as we look at the data, it has surprised us, because it hasn't been as catastrophic as we were expecting. It's definitely challenging, but as we come out of lockdown, I think those first-time managers are going to get more opportunities. I think what is clear, though, particularly on private equity, is that the average fund size of larger managers is increasing. So that will continue to result in capital concentration. And the target sizes of first-time managers is staying relatively speaking at the same levels as it has been in prior years. So yes and no. Yes, it will. The industry will get more concentrated, but not as much as we were anticipating only a few months ago.
Got you. So there's a follow-up question from Jeremy. He's asking for more granular data on private debt market with regard to corporate directs, infrastructure debt, etc. Also with regards to senior versus junior debt focused managers. Do you guys get into more specifics?
Yeah, that's something, we don't have that in this presentation, but that's something we certainly have at Preqin. I mean, the Preqin Pro platform is pretty good at pulling out these things, but yeah, we can get a request off to our team and send you some good data on that.
All right. The next question is, gentleman's asking, do you quantify excesses in private credit markets similar to public markets, leverage ratio, et cetera? How do the excesses apparent in investment grade, high yield, and loans fare relative to private credit?
I think that's probably a question for members of my team. It's not something that I look at personally. But again, I mean, Derek, if you'd like to drop me an email, I'll definitely send it on to a member of our team. I'm sure they'll have a good answer.
All right. I think this is more of a question for your real estate team specifically. This gentleman is asking for, Kirk's asking, do you see an appetite for commercial real estate, like / workspace? Which sector in CRE is most sought by investors? So it's more of an investment related question.
Yeah, I think again, we will have our global real estate report coming out very shortly, and as part of that report, there was quite a detailed survey that was sent out to both LPs and GPs. So the information is certainly there. I would suggest keeping an eye out for that report, as I'm sure that topic will be covered. But unfortunately, I don't quite have the data to hand on that.
Got you. Okay. This next question is about the popular topic of ESG regarding the analysis of it. How do you determine the impact to performance evaluation?
So this is a study that was done by a member of our team in the US, and he was looking at the return distribution of ESG compliant funds and non-ESG compliant funds. And he found that statistically, even though there was a difference in returns, it wasn't statistically significant. So that's the study we've done. I mean, obviously there's plenty more to do in that respect. You know, ESG is a sector that we're expanding our coverage on, so our data set continues to improve all the time. And I think, you know, we'll certainly do more analysis in that respect going forward. But the conclusion that we've drawn so far, as I said, is that ESG investing doesn't hurt your returns, which is a good thing. But there's no conclusive evidence that it improves your returns, and there's no conclusive evidence that it undermines your returns either.
I'm sure there's some people in the audience today that disagree with that comment, but
I'm sure there will be, yeah. Well, we'd love to see, you know, if anyone's got different views to that, we'd certainly like to have a discussion and see some evidence to the contrary. It would be interesting to look at.
So this next person's asking if ESG has been able to maintain its strength even through like the economic downturn we experienced during the pandemic.
Good question. I mean, it's really hard for us to say at this stage. I mean, our performance data, for us to have the reliable performance data to look at when all the funds have reported, we have more or less a 6-month lag. So we've only really just got the Q2 data through. So it's probably a little bit too early to look at that. But what we found in the past is that while there's not necessarily a big difference in returns, at least statistically, the variation of returns of ESG funds has been lower. So that might suggest that you would expect, you know, at least ESG to perform a little bit better. But it's hard to say. It's not something that we've done work on, and it's something that we'd have to wait a little bit more for more data to come through before we can do that.
So from this is from Bob in Palm Beach. He's asking from an asset raising perspective. Is this something that is like more appealing, more attractive, and does it have a positive impact on what's he trying to say here, on capital raising for the firm?
ESG. Is that the
Yeah,
registered
so like
ESG?
companies that
Yeah.
market themselves and companies that use the ESG label in their investment process and their marketing process, does that help them attract capital? Do you guys have any data, any statistics on that?
I think it certainly does. I mean, if we look at again, our global reports, we'll go into this in more detail, but the level of LPs that are requesting ESG compliant products is now the majority, and I mean it has been the majority of LPs for a while now, actually, and the number of compliant GPs is increasing quite dramatically as well. So I think it's almost becoming a necessity to have at least some ESG products, and I think that's why, you know, at Preqin we've launched this ESG product a couple of months ago, and that's basically to help LPs assess GPs in terms of their ESG transparency, so that they're being measured on dozens of various metrics, and that helps LPs, you know, come to a decision about what to do with their allocations, essentially.
So Cameron, before you go to today, what is your focus going to be for 2021 with regards to alternative investments and your responsibilities at Preqin?
Great question. Looking at a couple of things at the moment. I mean, one of them is we're looking at the pension funds in Latin America. We're seeing a lot of appetite for international private equity exposure from them. That's been increasing quite considerably in recent years, and we expect that to continue. But I think generally speaking, probably the main focus will be on APAC. That's where clearly there's a lot of investor interest. But as I said before, I mean, it's a challenging market. I mean, it's a nascent market. There are some issues in terms of getting, you know, majority deals done, getting buyout deals done, deal flow, regulatory problems. So the capacity of that market to absorb all that interest coming from international LPs is something that we want to take a closer look at, because one thing is having interest, but the other thing is having the capacity. So that will probably be the main focus for me.
How do you plan on measuring the capacity or the ability to scale?
I think we just want to look at the structural barriers to deal flow that have been existing. Now, of course, those challenges that are being faced in the market, they're not going to disappear, but we're looking for signs of improvement. We're looking for, you know, regulatory improvement. We're looking for you know, just increased signs of deal flow, increased acceptance of private equity by the industry there. You know, a lot of it is a cultural shift that's needed as well. You know, we wrote about this in Japan more recently. I mean, we're seeing that the frosty relationship that private equity managers have had with corporate Japan is it appears to be thawing somewhat, which means that there's more opportunity for deal flow. There's obviously succession issues that they need to be resolved, and private capital can come in and help that situation. So these are the kind of things that we're monitoring, and I mean, they're the main questions that we're fielding from our LP clients in terms of what's happening in that respect.
All right, great. I want to thank you for taking the time today. There are some questions that we did not get into, and perhaps they're more on the real estate side. So we'll pass along the questions that you know we actually pushed to the side, and then I want to encourage the people who have specific questions that weren't able to ask them today to reach out to you directly. Your email address is on the screen. And if anybody has a problem getting a hold of Cameron, just reach out to me and I'll be happy to send you his email address. We will be following up with a copy of the presentation for all the attendees today. And with that, I want to thank Preqin for being involved, you know, going on 6 years with us. It was another great presentation, great speaker. And thank you from the Flyer community for doing this kickoff today.
Excellent. Thank you very much.